What if I told you that two of the biggest economic stories of our time, one about a collapsing superpower and one about a 5,000-year-old metal, are actually the same story? And that Goldman Sachs, UBS, and the world's central banks are all quietly connecting the dots right now, while most people are completely asleep at the wheel? I'm going to break it all down for you today. No jargon, no fluff, just the real picture of what's happening, why your money is quietly being affected, and what the smartest investors on the planet are actually doing about it. If that sounds interesting to you, welcome. I'm so glad you're here. I'm your host on the Purple Analyst. Before we dive in, if you're new here, hit that subscribe button right now. I cover the big macro moves and money stories that actually matter for your financial life. All right, let's get into it. So let's start with China, because what's happening there right now is genuinely one of the most important economic stories in decades, and most people are only just starting to notice it. Over the past few months, some seriously alarming data has been coming out of Beijing. Consumer spending is down, lending is down, youth unemployment got so bad that the Chinese government literally just stopped publishing the numbers. They stopped collecting data on bond transactions. They stopped tracking patents. The foreign minister went missing and then got fired. The same is now happening to the defense minister. Now, I know what you're thinking. Did this all just happen out of nowhere? And that's the thing. It didn't. We just weren't paying attention. Think about what the rest of the world has been dealing with in the last few years. The war in Ukraine, 4 years of political turbulence in the US, Europe dealing with its energy crisis, Japan quietly remilitarizing, and for 3 years before all that, COVID. Everything coming out of China was filtered through the lens of the pandemic. Bad economic numbers? COVID. Supply chain problems? COVID. It was always COVID. So we never got a clean, honest look at the real underlying picture until now. Here's the part that should genuinely shock you. China's birth rate has dropped nearly 70% since 2017. That is the fastest demographic collapse in all of recorded human history. Not just China's history, all of human history. And the Shanghai Academy of Sciences suggests China may have been overcounting its population by over 100 million people, all working-age adults under 40. That means China already hit its peak workforce years ago. The workers needed to power the factory floor, drive consumption, and keep that economic engine running, there simply aren't enough of them. And wages? They've gone up 14 to 15 times over the last 22 years. That cheap manufacturing advantage? It's gone. On top of all that, China's Chairman Xi has spent the last several years running massive political purges, removing regional leaders, gutting rival factions, clearing out bureaucrats and private sector figures who could challenge him. He's also quietly eliminated the data pipelines, academic dissertations, political biographies, economic data sets that anyone could use to build influence. The result is a system where the leader may not even know there's a crisis, let alone fix one. This is not a temporary slowdown. This is a structural, demographic, political breakdown, and it has been building for years. We just weren't looking. So why should you care about this if you're sitting in the US, the UK, or anywhere else in the Western world? Because we are deeply, dangerously dependent on China for critical industrial goods. We're talking about transformers, transmission towers, the industrial equipment we need to rebuild our own manufacturing base. Some of these products already have wait lists that are over 36 months, and right now, a lot of us haven't fully accepted that some of those shipments may never arrive. The Biden administration, and this is a fact that often gets overlooked, is actually the most protectionist US administration in over a century, even more so than Trump. Reshoring is happening. American manufacturing is growing at a pace we haven't seen since World War II. That's actually a good thing, long term. But here's the uncomfortable truth. We started too late, and if China's collapse accelerates faster than we expect, which the evidence suggests it might, there will be a gap, a painful gap where the goods we need to build out our industrial infrastructure simply aren't available, and we haven't built the capacity at home to replace them yet. Add to this China's exposure to energy and food insecurity. With Europe pivoting away from Russia, China has to source energy through some of the longest, most fragile supply routes on the planet, going around Africa, past India, through the South China Sea. Any disruption anywhere along that chain hits China hard. The bottom line? The Chinese collapse is not just China's problem. The ripple effects are coming our way, through shortages, through price pressures, and through the broader reshaping of the global economy. And that brings us to the second half of this story, and honestly, the more actionable part. When the world's largest economy starts showing signs of structural collapse, global trade routes get disrupted, and governments everywhere are printing money to fund wars and deficits, where does smart money go? Right now, Goldman Sachs, UBS, and the world's central banks are all pointing to the same answer: gold. Here's what's interesting. Gold recently had its worst single month in 13 years, dropping 12%. And if you saw that headline, you might have thought gold was in trouble. But that drop had nothing to do with gold being a bad investment. It was caused by a liquidity squeeze. Let me explain that simply. Big hedge funds had losses everywhere: stocks, bonds, you name it. And when you need cash fast, you sell what you can, not what you want. Gold is one of the most liquid assets on the planet, easy to sell quickly, so it got sold first. Think of it like your neighbor who just remodeled his kitchen for $50,000, then loses his job and has to sell the house. Not because the house is bad, because he needs cash. That's exactly what happened with gold. The underlying reasons people are buying gold, none of them have changed. Central banks, the boss banks that control every country's money supply, have been buying gold for 15 consecutive months. China has poured $1.9 billion into gold ETFs. And China just passed a new rule allowing its massive insurance companies to put 1% of their assets into gold. That might sound small, but Chinese insurance companies are enormous. We're talking about a new wave of institutional buying that hasn't even fully begun yet. Meanwhile, Goldman Sachs says they are still, even after the price drop, quote, constructive on gold. That's Wall Street code for "we think it's going up and we're buying." UBS's chief investment officer says plainly, stay bullish on gold. Why? 3 reasons these banks keep repeating. First, stagflation risk. That's when inflation stays high but the economy slows down and jobs disappear. Gold has historically done very well in that environment. Second, a weaker dollar. The US is running a massive deficit, spending money it doesn't have and printing money to cover it. More printing means a weaker dollar, and gold moves inversely to the dollar. Third, lower interest rates ahead. When rates drop, the appeal of sitting in cash or government bonds drops with them, and money flows into assets like gold that can actually appreciate. Okay, so here's the part a lot of financial YouTube channels skip, the practical part. What does all this actually mean for you? I'm not a financial advisor, and I'm not here to tell you what to buy or sell, but I am going to give you the 3 questions I think every smart investor should be asking right now. Question 1. What are the biggest, most well-resourced institutions in the world actually doing with their money? Not saying, doing. Right now, central banks are buying gold and reducing dollar exposure. Chinese institutions are scaling into gold. Goldman and UBS are bullish. That's not my opinion. That's the data. Question 2. What is the crowd doing? Because when average investors panic and sell, that's historically when the smart money starts buying. We just saw one of the biggest gold sell-offs in years, driven by hedge fund panic, not by any change in the fundamentals. History suggests that kind of extreme selling tends to precede a rally, not follow one. Question 3. Is this a short-term trend or a long-term structural shift? Are the reasons people are moving to gold going to disappear next month? De-dollarization, countries moving away from the dollar, has been building for years. Geopolitical instability isn't going anywhere. Government deficits are not shrinking. Emerging market countries are quietly diversifying away from the dollar. These are multi-year forces, not a fad. Now, does that mean you should put all your money into gold tomorrow? Absolutely not. Balance is the word. A rational, considered allocation to assets that protect against inflation and currency weakness as part of a broader, diversified portfolio is something a lot of serious investors are thinking about right now. But how much, in what form, and through which vehicle, that depends on your own situation, timeline, and risk tolerance. So let me bring it all together. China is not having a bad quarter. It is experiencing a structural breakdown, demographic, economic, and political, that has been decades in the making and now accelerating faster than most of the world has realized. The ripple effects for the US and Western economies are real, and they're coming. At the same time, the world's smartest institutional money is quietly repositioning. Central banks, Goldman Sachs, UBS, they're all looking at the same landscape of debt, inflation, geopolitical chaos, and dollar pressure, and they're moving towards gold. You don't have to take my word for it. Do your own research, ask your own questions, but the information is out there, and now, so is this breakdown. If this video was useful to you, and I genuinely hope it was, please share it with someone who needs to hear it. Hit that like button, it helps more than you know. And if you haven't already, subscribe to The Purple Analyst. I cover these big macro stories every week, and I promise you, the next few years are going to have no shortage of them. I'll see you in the next one. Stay sharp.